Hi, and welcome to the New Property Show. I'm Steve McMenamin. This show is about investment properties in 2023. The do's, what's, how's and when's. This includes the benefits of long-term leasing, knockdowns and rebuilds. Today's topic, investment properties. The do's, the what's, the how's, the when's. Who wants to get us started on investing in 2023? Your thoughts on it, new versus old? Should you buy an old property, do it up? Should you build a new property? There's a lot of topics going on at the moment. I guess the buying segment has changed. You've said earlier some of the investors are leaving the market. Who wants to lead?
I think, like I said earlier, investors have started to leave the market over the last 12 months, which has been, look, a good and a bad thing. Rents have actually gone up when investors have left the market. It's supply and demand, very, very simply. So, look, I think if you are looking to buy as an investment, it is probably a pretty good time to start doing that over the next little bit. I think investing in property right now could be very, very beneficial to you because I'm predicting and we're predicting rents to go up by up to 20% in the next couple of months.
We're finding a similar story, I suppose, where we are seeing some early signs of some investors coming back in. They're chasing those returns, and I think lenders are also signalling that they're happy to take on a bit more of that debt, where they're allowing 90% of the rental yield that you'd get to be included in servicing rather than a standard sort of 70 or 80%. Mm-hmm. So that's a signal that we're getting in the industry that they're sort of opening up to that. So I think there'll be more of that in the new year.
I guess as a broker, I just want to quickly pass over to you just for a sec with this. What are they looking at in terms of lending nowadays? So if we're investing in Queensland, it's typically a 20% deposit, normally down. We're still doing 10% loans nowadays, sure. LMI. What's happening there with the lending market?
So it's pretty varied. Different lenders are going for different segments of the market. The gold standard is always that 80% or 20% deposit. There are some that do 15 with no mortgage insurance. Mortgage insurance is available up to 90%. They don't really most don't like going much past that for an investment property, but there are lenders who are doing guarantees on investment properties. So depending on your situation, if you've got a bit of equity in a property, there's usually a way to enter the market. And when you are obviously investing, and this is me swimming outside my lane a bit, you've got the whole of Australia to choose from. Whereas if you're buying somewhere to live, you're more restrained or constrained to where you want to live. So
interesting point of view. As I said, you really do open up that whole market. We talked earlier on another show about Hobart. I personally talk a lot about Queensland. Pete, where do you sort of lean into?
Well, I'm going to be a bit of a contrarian. Most of the arguments here are between negative cash flow and positive, whether you buy new or old. I actually think the principle of renting and investment needs to be reimagined. One of the key things with renters when they move, it's 10 to 15 grand for a family to move. Mm-hmm. So one of the big problems that we actually have in real estate and rental market is short-term leases. It's terrible, 1 year. Go to Europe, 40, 50-year leases. Sure. So one of the key things to actually get is find a good tenant near a good school. So if you want to know where to invest, find the good places. Once you know they're a good tenant, go for 3 to 5 year leases. Have an agreement in place where you have annual increases. Now the value of that, if you're going to loan against a property, if you've got long-term tenure and you have increases in rent over that time, the cost of moving is going to far outweigh those annual increases. And the other thing is that you have to imagine an investment property the way you would your own. People have the same dreams, same aspirations. For a good property, they will want to stay. And for a family, once they find a good school, if they've got multiple kids, they'll be there 15, 20 years. Sure. That never gets talked about.
Absolutely, and it's, if you don't mind, it's very much a commercial real estate type view, which means that if you're the landlord too, you're more likely to invest in that property and do some of the things that family wants you to do to that property if they're going to sign a long-term lease. I think there's definitely something in that.
Yeah, I think that's a big part missing from the conversation.
At what point do you think the landlord should really drive past, knock on the door and introduce themselves? I used to talk to my tenants a lot. I think obviously having the rental agency in place is obviously very important. But I've found over the years that tenants have actually done up my properties. They've actually asked, can they paint walls, can they put landscaping in? Have you come across that as well?
Yeah.
So would you go and suggest getting to know your renter or your tenant? Yeah.
So I met about 10, 15 years ago. I was doing a property in Burwood, and the guy who owned it was Costa and his wife Eleni. They own 6 properties in what are called blue chip suburbs today. Now, he managed all his properties, but at the end of each lease, he repainted everything. Part of the lease agreement, they looked after the gardens. He told me that the average rental term of his property was 5 years. And so he was no fool. I calculated last year that he had conservatively $20 million worth of property. And he understood this one thing, that for a tenant to stay, they have to feel like they belong, and he had space for them. You know, with agreement, you can paint, you can have a pet, but there was a good agreement, and he was a really good landlord.
That's great. What about you, Goran? What do you think?
I'm actually on both sides of the fence, believe it or not. In terms of long-term leasing, I love that, and in something that I'm passionate about, which is disability housing, one of the reasons we get our tenants actually to co-design our houses is because they feel a sense of belonging, exactly what you mentioned before, because they could stay in that house 20, 30 years, and like it or not, this might be a macabre subject, some of them this may be the last house they ever live in, right? So I feel that for those people with disabilities, giving them the dignity of being able to design their own house, owned by an investor, right? Owned by an investor, making sure it's still a commercial affair for mortgage broking reasons, a highly commercial affair, will allow you to have a longer term tenant. So on that side of the fence, complete agreement with you. And to be a contrarian, on the other side of the fence, some of the other things I do is, short and medium term accommodation, with the shared housing, right? Which I think there's also a gap for. And I'm probably in agreement with you. These 1 or 2 year leases in the standard residential probably don't work. Either you do 1 or 2 year leases or 6 month leases in shared accommodation, and you do your 4, 5, 6 year leases in your standard residential. That's fantastic. But there is still a space for that short term accommodation, as long as it's custom designed or custom modified for that purpose.
Well, it's actually interesting you say that. So we've done plenty of properties where we've done a property up, it's been sold, and they haven't yet found the new place. They should go to you for a new build. But outside of that, we actually reach out to leasing agents and say, what have we got for 6 months? And in order for this project to work, we've actually found them short-term accommodation. So there actually is a huge space for that to exist.
Yeah.
I think on both sides of the fence, I'd probably agree on both, but ultimately the goal is about, I guess, servicing and looking after your tenant, but really it does sit back on the landlord, and I'd be looking at wealth creation. So ethically, yes, you need to be the best landlord you can be, but what we want to try and establish, I guess, on this show and looking at wealth creation is in the short term, that 3 to 5 years, yes, we're looking after the tenant. If we throw, I guess, the net out a little bit further, and bringing about this in terms of value adding for investing, so what I investigate a different subject, would be possibly buying an older house in an area and letting people house sit for a while. So that's where you could buy an old house on a 1,000 square metre block with the intention of knocking it down. So I think in the meantime you could look after your existing tenant, maybe give them an ability to relocate, give them an opportunity to come back to a new townhouse. So how would you feel about that subject? So knowing that you're going to knock down a place, I know of plenty of people that do that, they're buying in an old area. How would you treat that? Do you think that's a good way of investing?
Actually, it's funny you say that. In Cranbourne right now, we actually got that project. We've got a project that we're working on. But the guy tried to develop himself, mucked it up, can't sell it as it is and can't lease it. But he wants to build on the back. The expense of building at the moment is just way more than he's going to get back. So we're doing the front place up. Even if he uses it, rents it out for 2 to 5 years, means he's got active income coming in. He's going to build at the back, when...
Has he subdivided yet, or he's going to subdivide?
Yeah, he's going through plans. He's moved. He started ripping things out before he'd settled all of that. But that said, This was the only way we could actually move forward. And this guy wants to be a serious developer. Based upon what we put to him, he said, I could replicate this all over the place. And it means he's not financially burdened. So build the rear block, then knock the house down the front, and then do the next part.
Okay. Thoughts on that? So thoughts on developing? You'd see maybe on your website, you could just do a search just based on house and land, but based on bigger blocks. Is 1,000 square metre blocks still existing, or you're pushing right out into Timbuktu?
Look, they still do exist.
Yeah.
Generally, it's not a knockdown rebuild on those 1,000 square metres. The further you go out, yeah, there's plenty of those, and it does start happening. But at a lot of times, the further you do go out, the less opportunity there is for you to subdivide and build on that. I also think that getting someone to rent and then come back is very, very difficult. You know, moving house is ranked as one of the most stressful things that you could possibly do in your life. And so many people on our site talk about how much they hated the moving process. So I think, yes, long-term leases are great, but I think moving someone out and then back in could be, you know, fraught with a little bit of danger, because if they move somewhere else and they find somewhere they like and they love, well, then there's that 3 to 5 year lease that you were talking about. So it's a balancing act, definitely.
What about you, Rory? Have you dealt with, I guess, a lot of people in terms of development finance? So
Sure.
they've gone in, they've purchased a property knowing they're going to develop it
Yep.
down the track. We've talked about debt reduction. I think it's a good way to create wealth.
Sure.
Are you dealing with those types of clients?
Yeah, we deal with quite a lot of them, and there's
Yeah.
definitely a marked difference between those who are trying to do it as a one-off and those who have done it repeatedly and do it quite well. There's definitely some tricks and traps for new players trying to do that. The ones that nail it and do it really well can do really well out of it, make some great money out of it. I just think that quite a few people try to do it and overstretch and run the numbers too lean, and that's quite problematic. But certainly, if it's done right, if you calculate if you do your sums right, there's some good money to be made in it.
Okay. I guess last question here. New versus old. I'll give you my summary in a moment, but if you're an investor watching this show, so I'll give you two answers or two questions here that you answer. So you're a 25-year-old and you're a 50-year-old. Which one would you buy and why? So we'll start with you, Guy.
So as a 25-year-old, I would almost certainly look at new property.
Yeah.
Especially if you've got a way, especially if it's for a couple of reasons. Number one, almost like an emotional decision where you've got, you know, you've got another 20, 30 years of good wealth generation ahead of you, then buy new, because new in the long term with house and land, I mean, we're here discussing house and land primarily, I'm not talking about apartments or townhouses, tends to grow in the long term, right? That's land grows. The challenge with a 25-year-old is that they don't have as much disposable income to spend on renovations, right? Or value adding to the property. Whereas a 50-year-old, I'll give you an example of my dad recently, right? He was 60, no, it was 70 when he purchased this. He purchased a holiday home in Gold Coast, right? We've discussed it. It's a holiday, beautiful home, 8 minutes walk to the main beach and Surfers Paradise, 4 minutes walk to all the party places, etc. It's got a private villa, a private pool, but he had to spend a considerable amount of money getting it to a place where it was both a holiday home and he could use it for an Airbnb rental. You know, there was costs upwards of almost $100,000 after the purchase, right? In order to get it to ship shape, in order to get the higher rental yield. So if you're 50, an existing property. If you're 25, brand new.
Cool. Pete?
Great example. When I was selling homes, I sold a home to two sisters. They were renting together in Dandenong. We did an estate not too far away from there. We found that their combined incomes, they could afford a new home with their deposits, but not doing the existing. But the key was, instead of getting a 2 or 3 bedroom home, I asked them a simple question: who are your 2 best friends that you could actually live with? And both of them knew straight away. So they rented with them. We built the home, and their actual cost to hold was significantly less than their rent. And so at 25, I think they were 20, one was 24, one was 26, best option. And so if you're young, buying a new home's the way to go. Like you just said, buying the existing home as you get older, that's a whole other ballgame.
Perfect. Rory?
Look, I agree, and I think that what it's been discussed really shows that it's so much about the person, it's so much about their situation. If you've got a lot of the time, young person doesn't have that sort of deposit, or doesn't have the equity to invest into an existing property, so they have to go down that new route, which is fantastic. But for me, it's really about, well, number one, as a mortgage broker, it's what a bank's going to approve, but it's also when you're closing in on retirement, you want to chase the rental yield, whereas if you're younger, where's going to get that capital growth? Because obviously the yield's going to catch up eventually. So it's more a question of capital growth versus rental return for me.
Perfect. And Dave?
I'm a little bit different. I think, look, there's places for both. It's pretty much, can you live through a renovation? Because I have, and it's pretty difficult. So can you judge yourself living through a renovation?
Yeah.
Or can you afford to stay at home with mum and dad, or with your friends for a bit longer? Because that can also be hell. So it's really, I think it comes down to what you need as a person and what you want. Do you want that brand new house that you move in and you do not have to do a thing and it's going to be perfect and you're happy to wait? Go for it. If you want something that you want to be able to put your own touch on and grow with the house, and you can live through the dust and all that sort of stuff, then definitely buy something that's older. And I think it doesn't really matter how old you are with those decisions. I think it comes down to what you want and what you need and what you can deal with. Yeah.
Cool.
Can I add to that, just from almost like a broking point of view here? I've noticed, and I'll give you comparison. So I bought a house in Coburg North, 1.2 mil. It's now currently worth circa 1.5, 1.6. Great, you know, we've had some growth, but at the same time, I bought a house in the outer suburbs in Doreen, which I think total house and land completion was circa 650. It's now worth 900, 950 plus, right? In the same time zone or time frame almost. So what's happening, and getting back to the borrowing capacities point of view, it also depends, the growth of a property that's over a mil that could be established. Most properties these days that are established are mil plus in Melbourne, right? And you know that borrowing capacities for a mil plus is a lot less compared to people at 600 plus.
Sure.
So yeah.
I feel, okay, sorry.
No, I was just absolutely. I mean, and it's just, that's a key component of it. How fast is that property going to go up in value? And it's all about what's the next step. You know, if someone just wants to have the owner occupied and an investment property, fantastic, it does it. But if you've got big plans to have multiple properties, then decisions like that make a big difference. Absolutely.
I think I'll just quickly summarise it and give you my thoughts on it. I think with a advantage as a 25-year-old is I'd probably lean towards new. Reason for it is tax depreciation being one. Second to that is if you've got to do a renovation, let's say it's a $100,000 renovation, it's really going to cost you $200,000 after you've paid tax. So it's really going to cost you that, and the least amount of risk. At least with a brand new property, something goes wrong, the builder will generally come along and repair it. You've got builder's insurance and warranty and that sort of stuff as well. Also, we talked about the small fish taste sweet, so buying a brand new property at the lowest amount, buying at the lowest value. You could see before with your example, you're still getting significant growth. So if you're getting 30% on 500 grand, that's still a great growth anyway. So I'd probably end with that. I think if you're 50, really at the end of the day, what you should be doing then is being conservative and not buying at that stage necessarily, but evaluating the properties you've already got and building wealth that way and making sure that you're in a good position for retirement and not taking risks beyond your means. So, guys, I want to thank you so much for joining us on the New Property Show. That was a really healthy debate. Thank you so much.
Thank you.
Thank you.
They're trying to obviously slow down inflation.
Yep.
There's some other things that we can do, which is, I mean, something you specialise, which is really just tips on saving.
Yep.
What would you say to the average household now, how they can actually control their spending, both fixed expenses and variable expenses? What would you suggest to those guys?
In an economy like this, it's very important a standard household actually spend a little bit more time trying to create a savings plan. The best place to start this is actually through a budget, but not through a traditional budget. We normally suggest our customers to do a budget where they focus on their fixed rate expenses and variable cost expenses. Your fixed cost expenses are the ones that happens regularly. So this could be your mortgage, this could be your rates, this could be your rego, so forth, right? The best way to manage this is always look for the market to find providers where they will provide alternative options. And also find solutions where you may be able to make your payments without too much stress on your monthly cash flow. So for example, your rego, instead of paying annually, maybe talk to the Vic Roads and see if you could pay that quarterly, because in that way it will have less stress on your cash flow. Your variable expenses are the ones that directly related to your lifestyle. So this might be your gym membership, eating out, and also like your subscription with Netflix, Spotify, so forth, right? Maybe try a day in your calendar where you will eat at home rather than going out. So that could be a method.
More date nights, for
More
example.
date nights at home, you know what I mean? So that will allow you to save a little bit more money on your monthly budget.
I think so. So I think what you're saying there is that basically people are still in control of their spending. And obviously we've got some fixed expenses, but what we need to look at is the variables. So the subscriptions, pulling down on those things that are negotiable. Land prices are going up, cost of buildings going up. Have you got things like valuation shortfalls? What would you suggest in terms of construction finance, and what do we need to look at there?
So we see two major challenges in the construction lending. Number one is what you just mentioned, valuation shortfalls, right? The best way to manage this is whenever you're signing up a land and a building contract, always make sure you do that subject to finance. Also make sure your building contract is a fixed price contract. And most importantly, have some savings for a rainy day, right? Another big problem we see at the moment is the time frames that it takes to complete a property. If you are a first home owner buyer, you might be paying your rent, the loan on your land, as well as interest on your progress payments. If you are an investor, you will be paying your land loan and interest on your progress payments until you get some rent. So it's very important to have some savings to actually face these unforeseeable circumstances.
What would you normally recommend in terms of savings put aside?
What I tell a lot of people is make it a percentage of your cost. So if you could get at least about 5% of your construction or the land and the whole cost as a savings buffer, that would be a really good amount to work with.
There is a few new schemes that are out though too. So for example, you've got first home buyers grants, you've got low deposit schemes. Do you want to just quickly rattle off what some of those schemes might be?
So there are a number of opportunities and actually benefits given by the government in order to help and boost the market, as well as help these first home owner buyers, right? My best suggestion here is work with your bank or the broker to find what works best for you. Also, there are lenders who provide benefits to the first home owner buyers. For example, Bank of Melbourne, they're doing 85% without LMI if it's your first property. So there are a lot of options. So it's very important you talk to your broker or your banker and finding the best solution that works for you.
I think that's great. Actually, I've learned something there. So banks have been a little bit more lenient and flexible there in terms of the lender's mortgage insurance. That's just quite a significant saving, just let alone. That could be $5,000 to $10,000. Last thing, I guess you've been in broking now for a while. Pre-approval, is that still relevant nowadays, or
absolutely,
what would you suggest?
It depending on the bank. So this is where you really need to use the services of a broker. Depending on the bank, the pre-approval conditions are different. For example, Commonwealth Bank, they will honor their pre-approval for 90 days. So that's something where we are actually using to help our clients. But then some banks don't honor their pre-approvals. So before you do a pre-approval, it's very important you have a conversation with your broker to find out if you purchase within the approval, will they still honor my approval?
That's all for this week. See you next week.